ratio is one of the most common tools investors use to judge whether a stock might be cheap, expensive, or fairly valued. But it works best when you understand its limits. Here's how you can use it to choose the right stocks. 1. Understand the formula. PE, frac, price per share, earnings per share, EPS. Price per share equals what the stock costs today. Earnings per share equals how much the company earns per share in the past 12 months, or expected earnings in the next 12 months if it's a forward PE. 2. Compare with industry average. PE ratios vary a lot by industry. Tech companies often have high PEs, 20 to 50 plus, because of growth expectations. Utilities and banks usually have lower PEs, 8 to 15. If a company's PE is lower than peers, it might be undervalued, or it could mean the market expects slower growth or trouble. 3. Compare with company's own history. Look at the 5 to 10-year PE range for that same company. If today's PE is below historical average, the stock might be cheaper than usual, good for value investing. If it's far above historical average, the market may be overly optimistic. 4. Understand growth and PEG ratio. A low PE isn't always a bargain. A company might be cheap because earnings are falling. Use PEG ratio, PE by earnings growth rate. PEG 1, fairly valued. PEG 1, possibly undervalued. PEG 2, possibly overvalued. Hint 5. Watch out for value traps. A very low PE, e.g., under 5, can signal real problems, falling profits, high debt, or industry decline. Always check other fundamentals, debt levels, cash flow, competitive position. Hint 6. Blend with other indicators. Combine PE with dividend yield if you want income, debt to equity ratio, financial health, return on equity, ROE, profitability, revenue growth, future earnings potential. Rule of thumb for beginners. 1. Find companies with PE lower than industry average but still growing earnings. 2. Avoid extremely high PE unless growth potential is very strong. 3. Avoid very low PE if earnings are shrinking or debt is high. If you want, I can give you a quick step-by-step checklist you can follow to screen stocks using PE the Warren Buffett way. That'll make it almost plug and play. Here's a step-by-step PE ratio checklist you can use like Warren Buffett would to quickly filter stocks and avoid bad picks. Warren Buffett-style PE stock screening checklist. Step 1. Collect the data. Get the stock's current PE ratio, use Yahoo Finance, TradingView, etc. Find industry average PE, look in industry section, or compare with peers. Check company's historical PE range for the last 5 to 10 years. Step 2. Compare with industry. If PE industry average, potential value. If PE is much higher, the market is expecting high growth. Only consider if earnings growth is truly strong and consistent. Step 3. Compare with company's own history. If PE is below the 5 to 10-year average, stock may be undervalued. If above average, stock may be expensive relative to its own history. Step 4. Check the earnings quality. EPS growth should be positive for at least the last 3 to 5 years. Avoid if earnings are unstable, falling, or inflated by one-time events. Step 5. Use the PEG ratio. PPIGI PEE by annual earnings growth rate percent. PEG 1 fair value, PEG 1 undervalued, PEG 2 overvalued unless growth is extraordinary. Step 6. Check financial health. Debt to equity 1, preferably lower. Positive free cash flow for at least 3 years. Consistent ROE above 12 to 15%. Step 7. Decide buy zone. PE industry average, PEGI 1.2, strong earnings growth, and good financial health. Caution zone. PE much higher than industry, PEGI 2, earnings unstable. Avoid zone. PE extremely low, 5 with falling earnings, high debt, negative cash flow. Buffett's twist. He prefers companies with predictable earnings and a durable competitive advantage, even if the PE isn't the absolute lowest. He'd rather buy a great company at a fair price than a fair company at a great price. If you want, I can build you a ready-to-use Excel or Google Sheets PE analysis template so you just enter a stock ticker and see instantly if it passes the checklist. That way, you don't have to calculate PEG or compare averages manually.